When you're trying to find a portfolio of investments, an ETF to invest in, it's very hard to find one that is better than SCHD. The Schwab US Dividend Equity ETF is arguably one of the best ETFs in the world, especially for dividend investors. So if you haven't seen it before, if you're interested in investing in this portfolio and this ETF, then this is the video for you. This is just going to give you the basic overview, the quick 10-minute summary as to why this portfolio is one of the best in the world, and why I think it has the opportunity to continue to outperform with a lower volatility in the market as we move forward. Thank you guys for tuning in. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I showcase my portfolio balance every single month at the first of the month, as you can see right here, since starting my YouTube channel back in April of 2020, as well as disclose my current portfolio balance, which is listed right here, and my portfolio performance and my holdings. These are shared down below using M1 Finance, and the description also shows you my portfolio holdings in the link that is shown right here down below. So if you're interested in getting signed up with M1 Finance, this portfolio that we're going to be showcasing, you can get signed up down below, get $10 for signing up, and help support the channel. But thank you guys so much for tuning in, and without further ado, let's go ahead and get started with ticker symbol SCHD, the Schwab US Dividend Equity ETF. Now in the last 5 years, this ETF has done quite well. It's up 44.67%. Now comparing this to SPY, the S&P 500 ETF that many people invest in, it's pretty comparable, putting up 45% for the SPY, but in the meantime, this company has produced a massive dividend yield that is far beyond that of SPY. As you can see, the S&P 500 right now has about a 1.6% average dividend yield. Right now, this portfolio has a 3.6 dividend yield based on this ETF and this basket of investments. Now we see the performance right here, but what type of companies does this ETF actually hold? What does a dividend ETF like SCHD actually invest in? Well, here's its top 10 holdings as of the last month or so when they last updated in this holdings tab. The top ticker symbol is MRK, or Merck & Company, in first place at 4% of assets. Next, you have Texas Instruments at about 4%. Actually, most of these are pretty much all at about 4%. Pfizer is third place. We have PepsiCo Incorporated coming in at fourth. We have number 5 coming in at Home Depot. We have Verizon Communications coming in at number 6. IBM International Business Machines coming in at number 7. Amgen is number 8, Cisco Systems Incorporated is number 9, and then number 10, lastly, we have Coca-Cola. Now, these portfolio holdings shift over time. They rotate. Sometimes it's higher, sometimes it's lower, sometimes these companies are kicked out or increased, and it's based off of this type of criteria. It says here in the Analytics Insight that SCHD is a market cap weighted fund whose selection universe only includes firms with a 10-year history of paying dividends. Within that universe, SCHD uses fundamental screens, which includes cash flow to debt ratio, return on equity, ROE, dividend yield, and dividend growth rate to build its portfolio. The objective is to focus on quality companies with sustainable dividends. As such, this approach gives the fund a modest large cap tilt and exclude REITs entirely. Individual securities are capped at 4% and sectors capped at 25% of the portfolio. Its overall composition is reviewed annually and the portfolio is rebalanced quarterly. Now notice here that it said the cap is around 4%, and that's where every single one of these are at when you exclude its cash. So basically 4% is the max that you're going to see a portfolio like this invested in. Now not only is it invested in all these different companies, but as it said, it's also maxed out at 25% for an industry. So information technology coming in at the top position, being at about 20% of the portfolio, about another 20% in financials, 14 and change in consumer staples, about 12-13% in healthcare, 11% in industrial, 6% in consumer discretionary, 5% in communication, another 5% or so in energy, materials at 3%, and then utilities at a teeny little tiny sliver. Now you can see that this is pretty diversified, not only in many different companies, but many different industries. These are all different types of companies. Merck & Company being a healthcare company, it's number 2 being a semiconductor, another healthcare company, a consumer beverage company, a brick and mortar store, a telecom company like Verizon is invested in many different companies, which this is what you want to see for an ETF such as this. You want to see this company diversified, and that is what has led to its pretty good performance. Now you can see its month-over-month performance here, and that's pretty decent, but part of this performance has come from, obviously, its dividends. I'm going to slowly scroll scroll through, this is from its inception back in 2013 when it was created, when it originally paid out 22.5 cents a quarter. Now, I'm going to scroll through here, and as I'm talking, you can see this slowly go up over time. All the way up in today's most recent payments in 2022, it originally was paying out 22.5 cents every single quarter, and as we approach up to the 2022 numbers, you can see that it's dramatically higher than what it was paying out almost a decade ago, with the most recent quarter paying out a record number of 63.7 cents, you can see right there, which is about triple of what it was paying out in 2013. And if you want to see this visualized, if we go over to Qualtrim here and we go to quarterly, you can see this dividend on a quarterly basis continually rise over and over and over again as its portfolio continues to collect dividends, and more importantly, that basket of companies continues to raise its dividend. When we talked about the selection criteria for how they get selected, it talks about companies that are in very good cash positions, companies that have lots of money behind them and have a long track record of paying dividends. Just as an example, if we type in MRK, which is Merck & Company, their top holding, and we go to quarterly and we look at their most recent statement on their balance sheet, you can see that their cash position is pretty healthy at a most recent stating of about $10 billion. And that is obviously sustainable when you consider that this company's free cash flow puts up annual numbers of around $8 to $10 billion every single year over the last decade or so. And that has been growing over time, as you've noticed, since the peak back in 2000. It started to hit a little bit more shakier times, but you can see that it's generally staying flat at around that $10 billion. And many of the companies included on this, like the second holding, which is TXN, Texas Instruments, it's actually a little bit different because this company actually has more cash than debt, with a record level $8.39 billion of cash on the balance sheet, and its free cash flow is not only meeting, but it's actually exceeding what it's done over the last decade, hitting a record $6.3 billion in free cash flow. Now, the real key here is that when you look at these types of dividends and you see them going up over time, it's easy to get excited and just think about all the money that you're going to getting paid, but oftentimes it's dividend payments like these that are growing that can lead to outperformance over the S&P 500, the Standard & Poor's 500 index that many people tally their investments against. Now, what I want to do here is I want to give a hypothetical $10,000 investment into SPY and S&P 500 and show the first type without dividends. This is if you just put $10,000 in, you put the dividend payments in your pocket, and you walked away like it never happened. Now, if you look at this, you can see that the performance actually slightly has lagged that of SPY. Since it was accepted, it was pretty close, but it has lagged, and that's not good. And not to mention the max drawdown, you see the volatility of this is actually not even nearly as good as you would expect for a company that's supposed to be stable. You can see that the max drawdown for SPY was 24%, and then the max drawdown for the Schd ETF was 22%. So basically the same, underperformance with almost the same amount of volatility with extremely close market correlation. Now, if you do the exact same thing, the same $10,000 investments, and you only do one thing, the only thing you change is you reinvest your dividends, you can see that the portfolio balance did two things. The first one is the Schwab US Dividend Equity ETF did outperform slightly, and it also did have a max drawdown that was less than that of S&P 500, and its worst year was significantly less. Furthermore, not only did this company produce less volatility with better performance, but more importantly, the portfolio income is dramatically different. If you pull up the portfolio income here and you start to compare the difference in these, it starts off pretty close and then it dramatically changes over time. You see at the beginning of the inception of the investment, it was $313 in dividends versus SPY's $249. And then over time, you can notice that it continually grows faster and faster compared to that of the S&P. And then in 2021, this $10,000 investment would have doubled that, just slightly over doubled that of the S&P 500. The S&P would have done 547 in dividends versus the SCHD's ETF's 1,138. And so this is the type of things you want to look for as an investor. If you're interested in a portfolio or a basket of companies that are defensive, that are growing, that are consistently getting bigger in businesses, increasing their moat, and are hopefully not nearly as volatile as many other stocks in the S&P 500, it's this type of ETF that you want to invest in. This is the type of companies I show in my dividend growth portfolio that I've handcrafted and that I update every single week, every month, every quarter, and I show you guys on every single video. And this basket of companies And this basket of companies that I have created has led to outperformance in 2020, only being down 9% in the last year while having less volatility. So I'm trying to replicate that of my own version of that of SCHD with this basket of incredible dividend growth paying companies. But I hope this gave you an overview of what you thought of SCHD. Hopefully it gave you some insight and made you want to invest in it if you like this company. But thank you guys so much for watching. If you enjoyed this video, I'd invite you to subscribe and check out all the stuff down below in the description, including $10 for getting signed up with M1 Finance. But without further ado, my name is Jordan. I'm a millennial investor, and I'll catch you guys next time.